Bitcoin ETFs are making waves in the financial world, but what exactly are they? And why is everyone talking about them? A Bitcoin ETF, or exchange-traded fund, offers investors a way to gain exposure to Bitcoin without directly owning the cryptocurrency. It's hailed as a game-changer for making Bitcoin more accessible to mainstream markets, yet critics warn of potential risks and limitations. In this video, we'll break down what Bitcoin ETFs are, how they work, and whether they live up to the hype. Are they the future of crypto investing or just another market buzz? Today, we will talk about Bitcoin ETFs explained. Are they worth the hype? So before we get started, make sure to hit that like button, also subscribe to my channel. Did you know that Bitcoin has grown from being a niche digital currency to becoming one of the most talked about financial assets in the world? Over the past decade, this revolutionary cryptocurrency has gained a loyal following, fueled countless debates, and disrupted the traditional financial system. Now, with the advent of Bitcoin ETFs, a whole new wave of investors is entering the crypto space. But here's the big question. Are Bitcoin ETFs truly worth all the hype? Are they the future of investing or just another way to cash in on Bitcoin's popularity? Stick with us until the end of this video as we break down everything you need to know about Bitcoin ETFs, covering their pros, cons, and what they mean for the future of finance. By the time we're done, you'll have the knowledge you need to decide whether Bitcoin ETFs are the right investment for you. 10. What are Bitcoin ETFs? To start, let's break down the basics. Bitcoin ETFs, or exchange-traded funds, are investment funds traded on stock exchanges, much like shares of a company. Instead of holding Bitcoin directly, these funds track the price of Bitcoin and allow investors to buy and sell shares of the ETF. For instance, let's say you're interested in investing in Bitcoin but feel overwhelmed by the idea of managing a digital wallet or navigating complex cryptocurrency exchanges. A Bitcoin ETF simplifies this by letting you invest in Bitcoin through your existing brokerage account. Essentially, it's a way to gain exposure to Bitcoin's price movements without the need to directly own or store the asset. This concept has made Bitcoin ETFs extremely popular among traditional investors who want the benefits of crypto without its technical challenges. Bitcoin ETFs work by either physically holding Bitcoin or using derivatives like futures contracts to track its price. The idea is to mirror Bitcoin's performance as closely as possible, giving investors a familiar way to participate in the cryptocurrency market. 9. Why are Bitcoin ETFs so popular? There's no denying the appeal of Bitcoin ETFs. Their popularity boils down to one thing: simplicity. Investing in cryptocurrency has long been associated with risks like hacking, forgotten passwords, and complicated exchanges. Bitcoin ETFs remove these barriers by allowing people to invest through platforms they already know and trust. For example, instead of downloading a crypto wallet, buying Bitcoin on an exchange, and worrying about its security, an investor can simply buy shares of a Bitcoin ETF. This accessibility is particularly attractive to beginners and institutional investors alike. Moreover, Bitcoin ETFs have the potential to attract investors who were previously hesitant about entering the cryptocurrency market. Institutions like pension funds and mutual funds, which often face restrictions on holding cryptocurrencies directly, can now gain exposure to Bitcoin through ETFs. This shift is significant because it signals the mainstream acceptance of Bitcoin as a legitimate asset class. The more traditional investors get involved, the more Bitcoin's reputation grows, potentially paving the way for wider adoption. 8. Bitcoin ETFs versus owning Bitcoin directly. One of the most important distinctions to make is the difference between investing in Bitcoin ETFs and buying Bitcoin directly. When you own Bitcoin, you have complete control over your asset. It's stored in a digital wallet, and you hold the private keys that secure it. This setup allows you to use Bitcoin as a currency, transfer it across borders without intermediaries, or hold it as a long-term investment. Bitcoin ETFs, on the other hand, provide indirect exposure to Bitcoin. Instead of owning the cryptocurrency, you own shares in a fund that tracks its price. This arrangement offers convenience, but also comes with limitations. For example, with a Bitcoin ETF, you can't use your investment to make purchases or transfer funds. Additionally, Some ETFs rely on futures contracts rather than holding Bitcoin directly, which can create discrepancies between the ETF's performance and Bitcoin's actual price. 7. Types of Bitcoin ETFs. There are two main categories of Bitcoin ETFs: spot ETFs and futures ETFs. Spot ETFs are the more straightforward of the two. They directly track the price of Bitcoin, giving investors exposure to its real-time market value. For long-term investors, spot ETFs are often seen as the ideal choice because they closely align with Bitcoin's actual performance. Futures ETFs, on the other hand, are based on futures contracts, agreements to buy or sell Bitcoin at a predetermined price on a specific date. These ETFs don't hold Bitcoin directly. Instead, they speculate on its future price. While futures ETFs can be useful for traders looking to profit from short-term price movements, they come with additional risks. Factors like contango, where futures prices are higher than the spot price, can erode returns over time. Both types of ETFs have their pros and cons, and choosing the right one depends on your investment goals. 6. The role of regulation. One of the biggest advantages of Bitcoin ETFs is their regulatory framework. Unlike traditional cryptocurrency investments, which operate in a largely unregulated environment, ETFs are overseen by financial regulators. This added layer of oversight provides peace of mind for investors, especially those who are wary of the risks associated with crypto exchanges. For example, when you invest in a Bitcoin ETF, you don't have to worry about hacks, scams, or losing your private keys. However, it's important to understand that regulation doesn't eliminate all risks. Bitcoin ETFs are still subject to market volatility, and their value can fluctuate based on Bitcoin's price. Additionally, the approval process for ETFs varies by country, which can impact their availability and structure. 5. Benefits of Bitcoin ETFs. So, who stands to benefit the most from Bitcoin ETFs? The answer is almost everyone. For institutional investors, ETFs offer a way to gain exposure to Bitcoin without violating internal policies or regulatory constraints. This is a game changer for hedge funds, pension funds, and other large-scale investors. Retail investors also benefit, particularly those who are new to cryptocurrency. By trading Bitcoin ETFs through familiar platforms, they can bypass the steep learning curve of crypto investing. Bitcoin ETFs are also an excellent diversification tool. By adding Bitcoin exposure to a portfolio, investors can potentially increase their returns while reducing overall risk. 4. Risks to consider. While Bitcoin ETFs offer many advantages, they are not without risks. The first and most obvious risk is Bitcoin's volatility. Even though ETFs provide a more regulated way to invest, their value is still tied to Bitcoin's unpredictable price movements. Another potential issue is tracking error. Some ETFs, particularly futures-based ones, may not perfectly mirror Bitcoin's price due to factors like contract rollovers. Finally, management fees can eat into your returns over time. While these fees are typically lower than those associated with mutual funds, they can still add up, especially for long-term investors. 3. The debate over spot ETFs. Spot ETFs have been a hot topic in the crypto world, and for good reason. Unlike futures ETFs, spot ETFs track Bitcoin's actual market price, making them a more accurate reflection of its value. However, regulators have been hesitant to approve spot ETFs due to concerns about market manipulation and insufficient oversight. This has led to frustration among investors and sparked debates about the future of crypto regulation. Despite these challenges, the demand for spot ETFs remains strong, and many believe their approval is inevitable. 2. The impact on Bitcoin's price. The introduction of Bitcoin ETFs has had a profound impact on the cryptocurrency market. By making Bitcoin more accessible to traditional investors, ETFs have increased demand, which has, in turn, driven up its price. At the same time, ETFs have added a new layer of complexity to the market. Their ease of trading means investors can quickly enter and exit positions, potentially leading to increased volatility. 1. Are Bitcoin ETFs worth it? Ultimately, whether Bitcoin ETFs are worth the hype depends on your investment goals. If you're looking for a simple, regulated way to invest in Bitcoin, ETFs are an excellent option. However, if you value Bitcoin's unique features, like decentralization and utility as a currency, you may prefer to invest directly. Bitcoin ETFs have revolutionized the way people invest in cryptocurrency, offering a bridge between the traditional financial system and the digital economy. Whether you're a seasoned investor or just starting out, understanding the pros and cons of Bitcoin ETFs is crucial for making informed decisions. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.